we have Taimur Baig waiting by to talk economics, right? I mean, MD and Chief Economist at DBS Research, DBS Group Research. Taimur, thanks for waiting. Apologies. I know you've been sort of listening in, but it's a big one. From a economics perspective, from tariffs and trade, how do you read this Trump sweep? And it is a sweep because he's got the Congress and he's got the presidency.
No, he doesn't. He doesn't. Let me correct that. You guys have been talking about it over and over again. That's not correct. He doesn't have the House. It's still too early to call. The Senate, yes. The presidency, of course, historic. But don't say sweep. It's not correct. Maybe it will be at some point, but not yet. In terms of
aren't they already calling?
No, absolutely not.
Okay,
House has many seats, waiting to be decided in the West Coast. It'll take weeks, not even today or tomorrow.
Okay, all right. So we won't. It's yeah, sure. So presidency and Senate. Go on. Implications of the election for emerging markets. Go on.
Right, and we should not sort of separate economics and markets. They're intertwined. So oil is economics and markets. Crypto is economics and markets. So let's say what happens to the expected currency/interest rate nexus for emerging market economies if the Fed cannot cut a lot of interest rates in 2025 because Trump's policies of cutting taxes and tariffs would push up inflation, and then that acts as a brake on the entire EM dynamic, which is rate cuts, which means lower cost of capital, which means buoyant equity and capital markets. So I think that is the first spoiler for emerging market economies that we have to consider, even before we talk about the broader implication for company earnings on the back of higher tariffs and what that means for the competition landscape for exporters in Asia and the rest of the world for that matter. So right now, I think we need to be very careful about saying what is good for the US. Is it necessarily good for the rest of the world? I think Mr. Damani made some very good points in the discussion that you were having earlier, that the post-Second World War setting was one where the US was sort of the rule-setting body, was promoting multilateralism, open markets. And over that dynamic, you basically had a situation where what was good for the US was good for the rest of the world. It is not clear in an America first, inward-looking policy of Donald Trump, what's good for the US is necessarily good for the rest of the world. So when we talk about Trump trade, we talk about strong dollar. That means EM currency is under pressure. When we talk about Trump trade, we talk about lots of treasury issuances, which may be good because it's basically a result of lower taxes for Americans, but it will probably mean higher interest rates for the rest of the world. When we talk about immigration-related issues, again, going back to Mr. Damani's point, it might be great for some workers who faces less competition from immigrants, but for the rest of the world, it's a more restricted U.S. market access, and that's a problematic thing. So we will take the U.S. rally, of course, in our strides. Most of us and our clients are long U.S. assets, and it'll be great with a strong dollar and a roaring equity market. But when we talk about the world as a whole, I think the impact has to be seen with a far greater degree of nuance.
Taimur, hi, afternoon. You spoke fewer rates by the Federal Reserve in 2025 because of inflationary concerns due to Trump's policies. So how many do you think we now should expect realistically?
I think we should wait till Friday morning when we hear the Fed's commentary. Again, alluding to the earlier conversation, Powell has to be careful. He has a job to protect, and if he sounds too hawkish and starts saying that, we'll have to be very data dependent and have to see the path of fiscal, I think his job will be on the line. So I think that the Fed itself would be very cautious in revising down or guiding the market down with respect to rates for 2025, because we also don't know. I mean, let's also give Trump some breathing room. We can't force our narrative of fiscal irresponsibility right now. He needs to get elected. He needs to have a budget. He needs to pass legislation. Then we will see. So till then, I think a couple of rate cuts in 2024 and some rate cuts in early 2025, that story remains intact. We're not talking about inflation jumping today. We're talking about inflation being a concern for the medium term if indeed fiscal policy is not responsible. So we think that a couple more rate cuts, which will take us to 4% Fed funds rate by the end of this year, is still on the cards. We think that at least 50 basis points of rate cut is on the cards for the first quarter or the first half of 2025. Do we go down to significantly below that? That is the big question. Do we go down well below 4? Do we go down to 3.5, 3? Could have made those arguments a couple of months ago. Fed was also sort of supporting that narrative, I think that narrative is under a great deal of challenge.
Taimur, you said what's good for America is not necessarily good for emerging markets. So there is concern that global growth is going to slow down on account of tariffs. How worried should we be? Will this play out only in 2026? Have you done any kind of analysis, if indeed that 60% tariff on China comes through, 10% on tariffs, 10% tariffs on rest of the imports from the world? Have you done the math for this?
Right. So a week and a half ago, the IMF released its World Economic Outlook, and we have copious amount of modeling information on what is the impact of tariff on global growth and the risk from the tariffs that have already been imposed and the cost of what the IMF terms as the economic fragmentation. So I think the analysis is clear. We've already lost a good 25, 30, 40 basis points of global growth on an annualized basis around higher tariffs. We're likely to lose more if indeed we have even higher tariffs going forward. And it is not just a question of a one-off, like 1 year you have tariff and then you move on and you sort of collect the pieces and things are better. It's a permanent loss in global outlook in terms of economic vitality and potential. So the answer is unambiguously negative. Tariffs hurt the rest of the world. The impact on the US is a bit ambiguous in the short term because it offers protectionism to American companies. It offers some protectionism to American jobs. But over the long run, even that is somewhat diluted by the loss of competitiveness and loss of overseas market access because there is tit for tat on tariff. So by and large, I think there's enough evidence and enough estimate to suggest that the plans that Donald Trump has with respect to raising a wall of tariff and the resulting trade war that we're going to have would be an unambiguous negative for global growth.
Okay, Taimur, since you began by saying emphatically it is not a sweep, and I agree with you, it is not a sweep. It is not a sweep yet. So let's consider the other possibility, which is the fact that the Democrats take the House, right? So then you got a Republican president and you got a divided Congress. Now, tariffs, you don't need the Congress to give the go-ahead. But for any stimulus on the fiscal side, etc., you need the Congress. If it indeed is a Republican president and a divided Congress, is it possible that you get the tariffs and all the rest of the stuff in terms of what Trump has been talking about, but you don't get the offsetting stimulus? So in that sense, from purely a markets lens, it's not exactly good news. It's not exactly great news. You will get the tariffs, but not the offsetting fiscal stimulus. Go on.
Right. So if I were a fixed income investor, a divided house would be music to my ears, because as you can see already, the action that we have seen in the fixed income market, the sharp steepening in yields that we have seen over the last few hours suggests that the market does expect Trump to be emboldened and be unchecked. And as a result, U.S. fiscal will go for a toss. It's already in bad shape. It'll go worse. And therefore, we will expect well north of 4% 10-year yield and perhaps close to 5%, even higher than that 30-year yield. So that would be a major tightening of financial conditions at the long end of the spectrum if we see the House, the Senate, and the presidency all with Trump. Whereas if we do see some degree of check and balance, we would expect a modicum of fiscal responsibility. And therefore, as a fixed income investor, I'd be a little more constructive. On the equity side, it is very clear. If Trump is riding on the back of large corporate income tax cuts, it would be great for the margins of companies, U.S. listed companies, and they will therefore profit handsomely. And that is what the market is pricing in. If we cannot have those things passed through the legislative route, the outlook for the equity market is a bit mixed. For U.S. dollar investors, Trump's ability to impose tariffs independent of the House and the Senate outcome means it should be a long U.S. dollar story, because tariffs would mean other countries will have to weaken their exchange rate to balance out the loss of competitiveness because of tariff imposition. So I think the dollar, the equity, and the fixed income space have fairly different sort of implications for investors depending on the U.S. election outcome. But on the dollar in particular, doesn't really matter. Trump has all the power. The dollar should rally.
And where does this leave the Fed, Taimur, to round this up? I mean, it's a real complex situation, right? Yields are rallying, prices are falling. There's this whole deficit situation that's become very real now. What about the Fed?
Right. And we should definitely put the Fed discussion in the context that it is not all about Trump. Leading into this election, already, I think the Fed was being questioned by the market. whether the September 50 basis points rate cut was the right thing to do, whether they have really been able to put the inflation genie back into the 2% bottle, whether there's any seriousness either in the Harris or the Trump camp in dealing with this $1 trillion deficit and $1 trillion interest payment that the US is now undertaking. So I think the November meeting, starting tonight, going into tomorrow and the day after, would already been subject to that sort of questioning, independent of the election outcome. Now we have another layer of complexity with Trump getting elected, and I think it was rightly alluded to in the earlier section. He would certainly demand lower interest rates from the Fed, regardless of what the macro situation is. If the macro situation is indeed one of strong earnings, strong wage growth, strong employment, and sticky inflation, how can the Fed go out and convincingly cut rates by 100, 200 basis points? It cannot. So that's where the seeds of the conflict is being sown as we speak. But that issue would have been there even without the Trump victory. It's just exacerbating or compounding it further.
What's for sure is that I don't think anybody would envy the U.S. Federal Reserve Chief's position right now, given the absolute stark contrast and the complexities that are playing out after this election mandate. Taimur, thank you very much for joining in. Really appreciate that perspective. And we look forward to more conversations as some of these policy issues become a little more clear.